Welcome to The Explainer. Today we're taking a look under the hood of a company that's about to go public, Exato Technologies. We're going to see what makes them tick.
All right, so this AI company, Exato Technologies, is asking for your money. The big question is, should you give it to them? We're going to dive deep into their official IPO prospectus. You know, the story they're telling investors. Our job here is to see if that story actually holds water and give you the tools you need to figure out if this is a golden opportunity or a risk you should probably avoid. So how are we going to do that? Well, we've got a 6-step investigation. We'll start with the big picture, their pitch, and drill all the way down to the price. By the end, you'll have a solid framework for analyzing this IPO and really any IPO that comes your way. All right, let's dive in.
First up, the pitch. Let's get to the basics. What exactly is Exato Technologies and what's their whole story?
Okay, so their official term is a customer transformation partner. Fancy, right? What that really means is they operate in a space called customer experience as a service, or CXaaS for short. Here's a simple way to think about it. Imagine a business's entire customer service operation, call centers, support chats, you name it. Instead of building all that complicated stuff themselves, they can just use Exato's cloud-based platform, which is all powered by AI. It's kind of like outsourcing your entire customer service department to the cloud.
Okay, that sounds pretty slick on paper, but you know what really matters? How they make money. So let's get into the business model.
Now, this is where it gets really interesting. Take a look at this. You can see there's been a pretty big shift in how they do business. In the last fiscal year, 57% of their revenue, that's more than half, came from what's called annual recurring revenue. We're talking about subscriptions, long-term contracts, basically money they can count on coming in year after year. So what? Why is that a big deal? Well, for investors, this is huge. It means the company is moving away from just making one-time sales. Instead, they're building a steady, predictable stream of income. It tells you that their customers aren't just trying them out, they're relying on them. Their service is becoming essential, and that's the kind of stability that gets investors really excited. Okay, so the business model checks out. It looks solid. But, you know, a good story is one thing. Do the actual numbers back it up? Let's dive into their financials and see what's really going on.
And wow, right off the bat, you can see some really strong revenue growth. I mean, look at that jump from around 7,200 lakhs just a couple years ago to over 12,400 now. That's a pretty clear sign that the market wants what they're selling.
And it's not just about getting more sales. Look at this. Their actual profit has skyrocketed. It basically doubled in just the last year. That's so important because it means they're not just growing, they're getting smarter and more efficient about how they operate. They're turning more of that revenue into cold, hard profit. But wait, there's this one number, and you kind of have to dig for it in the prospectus that gives us a peek into what's coming next. Their current order book is sitting at over 348 crores. And an order book, if you're not familiar, is basically guaranteed future money. It's work they've already been hired to do. So this isn't just wishful thinking about the future. They have a huge pipeline of confirmed work from some big-name clients. That's a really nice safety net, right? It provides a buffer against whatever the market throws at them. So let's recap. The company is growing, it's profitable, and it's got a ton of future work lined up. That brings up a big question. Why do they need to go public now? What are they going to do with all that cash? Let's check out their plan.
Okay, so the money they raise is going to two main places. First, they need it for working capital, you know, to keep the lights on and fund their growth. And second, and this is the really exciting part, they're going to pour a bunch of it into developing their own software. This is all about building out their tech to get a real leg up on the competition. And they're being pretty specific about it. A big piece of the pie, 680 lakhs, is going straight into R&D for their key software products. What's really telling is how they're spending it. The prospectus says most of that money isn't for servers or ads, it's for people. They're hiring top-tier tech talent to build out these platforms. They're investing in brains, which is a very good sign.
All right, so the story is sounding pretty good so far. But you knew there was a but, right? No investment is perfect. Every company has to list its risks in the prospectus, and it's our job to read that fine print. So let's look at some of the things that could go wrong. And this first one really jumps out, and it's a direct quote from their own document. Essentially, none of the directors on their board have ever served on the board of a publicly traded company in India before. Now, they might be experts in their field, for sure,
But running a public company is a totally different beast. You've got intense regulations, shareholder pressure, constant reporting. It's a whole new level of scrutiny. That lack of experience is a definite red flag. And there's more. The company itself admits to having a history of being late with some of their required paperwork, things like tax filings. To be fair, this can happen with fast-growing companies. They're moving so quickly that some of the administrative stuff falls behind. It's not necessarily a deal breaker, but it does make you wonder, right? It raises a little question mark about whether their internal systems are really ready for the big leagues of being a public company.
Okay, that brings us to the final, and maybe the most important question of them all. After weighing the good and the bad, is the price right? Let's talk about valuation. So to figure this out, we can compare Exato to its closest publicly traded competitor, a company called Black Box Limited. Let's look at two key numbers. First, the PE ratio. Think of this as the price tag on the company's earnings. Exato's is lower, which on the surface makes it look like a better deal. Then you've got return on net worth, which is all about how good they are at making money with the cash investors have put in. And here, Exato's number is way higher, which suggests they're running a much more efficient business. So, on paper, looking at these numbers, the valuation seems pretty attractive, right? It looks cheaper and more efficient than its main competitor. But here's the million-dollar question for you as an investor. Are those good numbers enough to make you overlook the risks? The inexperienced board, the past filing issues. This is where you have to make a judgment call.
So there you have it. We've walked through the whole framework. We've seen the good stuff, the incredible growth, the recurring revenue, the big order book, and we've looked at the red flags, the management's lack of public company experience. The prospectus gives you all the pieces of the puzzle, but it doesn't give you the final answer. So what's it going to be? Does this company have what it takes to succeed, or are the risks just too high? That's a decision only you can make.